I'm at Georgetown University for the next installment of the Real Estate Luminary series, which is sponsored by Georgetown's McDonough School of Business and NAREIT. Joining me is Brian Gill, adjunct professor of real estate and finance at Georgetown University and managing director of Kalorama Realty Capital. Brian, you co-founded your firm in 2008, right when all the credit crisis was going on. What opportunity did you see in the market at that time?
Well, a couple of opportunities. The big opportunity obviously was for investors. And a lot of investors saw in the run-up of 2005, 6, and 7 in particular were sort of the peak years of the market, valuations gyrating in a way that real estate never was meant to do. They were relying on cap rate compression or multiple expansion, depending if you're talking about public or private markets, to fuel total returns. And we saw an opportunity to come back to a normalized market and to get back to basics and help institutional investors understand that real estate never was or should have been about that. Real estate is a cash flow business, and it's on the debt side supposed to give you a attractive risk-adjusted spread over Treasuries. On the equity side, it's supposed to give you that plus maybe some positive inflationary growth. And then if you do get some sort of cap rate compression or multiple expansion as a kicker, then that's just an added benefit.
How would you describe where the real estate capital markets are today?
We see what I would call a barbell in the market. And so on one end of the risk spectrum, the core end of the risk spectrum, you're seeing CBD office and other types of assets that were trading at very high valuations in the top of the peak of the cycle, trading right where they were at the peak of the cycle. And on the other end of the spectrum, the opportunistic and distressed end of the spectrum, you're seeing also very aggressive valuations that, frankly, if you look at it, aren't really far behind where the core assets are going. And then in the middle, you're seeing a dearth of volume in the sort of what we might traditionally call core plus and value add plays in real estate, where it's either an asset class that's out of favor or maybe a suburban asset or an asset in a non-core market that people are unfairly discounting because of the perceived risk. And so we think that just like there was in the top of the cycle, there's still a mismatch between yields and risk. But there's opportunity if you're looking for yields in the right part of the risk spectrum.
And do you think, at least in the short term, that we'll see the ends of the barbell get bigger, or do you think more investors are going to focus on that kind of the middle spectrum that you talked about?
Because of the liquidity on the sidelines, I think you're going to continue to see that those barbells get bigger. The question in my mind becomes, how long will investors accept a 5% return in what is probably going to be over the longer term a rising interest rate environment over a 5 to 10 year time horizon? How long are they going to accept 5% returns in assets that don't produce significant income growth over a longer period of time like that? And my guess is they will start looking towards strategies that produce higher current cash flows and will give them better protection against a rising rate environment.
Well, it's definitely something to keep our eye on. Brian, thank you very much for joining us.
All right. Thank you, Matt.
For REIT.com, I'm Matt Bishar.